Sowilo Investment Managers is now with us on the show. Sandip, your first thoughts on 4% downside in IT stocks, 2% now. What is it that you anticipate?
No, so Rima, you have very nicely, said most of it. But let me say this: that we should see the Indian IT space in three directions now. First of all, if it was tariff, then you can pass on some cost pressures to the client, and you can find out a way. But here, it is not about tariffs; it is about global growth coming down, and you know that global growth coming down for a sector which has 80-90% exposure to exports is a very, very scary thing. And secondly, the domestic exposure, whatever they have, they don't make much money in that. So, there is a double challenge. There is a growth challenge and there is a margin challenge. So both the challenges are there. Additionally, remember that till now, neither tariffs have been announced nor any cost of doing business increase has been announced. So since November, when, presidential elections were happening, that time, we have been saying consistently that the cost of doing business can definitely go up. Although you can't execute this services project in US for sure, but there could be more cost implications. So that is still not there. Tariff is still not there, and right now we are only dealing with the uncertainty related to growth. So I think there could be multiple legs of disappointment. One, growth; second, margin pressure; and third, uncertainty. So I believe that there is still downside here. And I will not call this bottom. In my view, probably once guidance starts coming in, which I believe that, the companies must give some guidance, even if it is 0%, because then at least it will remove the third risk, that is the uncertainty risk, at least from the picture. Problem is that if they don't issue a guidance, then the uncertainty risk still persists. So my view is that the EPS can actually decline after a long period of time in FY26, and that is what I'm fearing.
But Sandip, the last time we had this kind of an uncertainty and growth scare was in 2008 and then COVID. Are we in a similar situation for Indian IT right now?
So, in COVID, what happened, it was very short-lived, and immediately people realized that, you have to do work from home. So right now, the situation is totally different. In COVID, it was a pandemic kind of situation where you're not able to go and work, but you can do remote work. Right now, the problem is whether there is a demand. And Rima, very well that, one or two large contract getting postponed or cancelled or in abeyance, any such announcement will bring down the multiples of the sector in a very significant way. We have seen that in past with RBS and other contracts. So my worry is that any large contract cancellation, non-issuance of guidance, decline in quarterly number, any of this stuff will bring down the multiples substantially, because the multiples are very, very high still, given the growth prospect. The PEG ratios for large caps are like 4-5 times. The PEG ratio for mid caps are like 8-9 times. That is very, very high. So we definitely need to be very careful, because the growth will come down substantially if uncertainty doesn't go, and the multiples have not come down to that extent.
Okay. So what is the growth estimate for FY26, say for large cap IT names on an average? And how much higher are the PE multiples? My point is, what should be the growth rate for FY26 to your mind, and what are the appropriate PE multiples you should ascribe for that kind of a growth rate, and how much higher are we currently? What's the extent of derating?
So I think, for the large cap, expecting beyond 4-5% growth for any of the large cap will be very, very risky. I think that is the max. So you should expect from -2% to 5% for large caps. I think that is a decent range. And for high growing mid caps and small cap, maybe, up to 10-12%. Now, given that the multiples are where they are expensive. In my view, if my growth will be below 5%, I should not go beyond 16 to 18 multiple. That also because this is a cash rich sector, there is a dividend support and all those things. And if the growth is like 10-12%, why should I go beyond 25-28 times 1 year forward? And I think right now the multiples are nowhere close to that. So I believe that, there is a risk to this numbers and multiple level of risk. Remember this, what we are talking about is only growth. Now, if, cost of doing business goes up and margin can definitely take a hit, because remember in IT, the nature of the business is such that 70-80% revenue is given, means it is always there because you are servicing contracts for long term. But 20% of the business has to be new, and additionally for 5% growth, you need 5% new business. So 25-30% business in this environment, new in such uncertain environment, profitably is a really tough task. And you can't, postpone your wage hikes for a long period of time. And even if you postpone wage hike, there are other costs which are like rent and other things which can't be postponed. Airlines, hotels, you are seeing the travel costs are going up substantially. So margins will also be under pressure. So there is double whammy on that.
Okay, so large cap IT companies to see a max growth of 4 to 5%, and therefore the PE multiple they should be trading at fair value should be 16, 18 times. And currently, most of the IT companies are above 20, going up to about 23, 24 times for TCS. And even for high-growing mid-cap companies, PE multiple should not be more than 25 times. So Sandip, the entire IT space is in a void, or are there any stocks that you like? What are you advising your clients? And especially if they have, positioning in tech stocks already, should they be looking to sell right now?
No, so a major damage has happened in last 5-6 months. We are in probably the last leg of damage where another 10-15% correction can happen, and we can't say it for all the stocks. So, in my view, if someone has positioning, better to stay for long term. If someone wants to enter, maybe around the results when all the worst is built in, then you can start nibbling and build positions. We still prefer ER&D, but as you rightly mentioned, ER&D stocks are still very, very expensive. I am not at all comfortable to pay more than 25 times for even ER&D stocks, although they will grow at double the rate of the IT services stocks. So for long term, they will make a lot of money. But I think, there is uncertainty. The problem is not growth. Once, companies say that, okay, we are going to grow at this rate, then you can do the modeling. Right now, there is uncertainty on growth, there is uncertainty on margin, and there is uncertainty on cost of doing business. So three uncertainties, how to assign multiple and all this. So it is a really challenging scenario right now.
We'll keep coming to you to get advice for our viewers on what they should be doing right now. But thank you, Sandip. This was an enlightening conversation. And big cuts. Coforge down 6%, Persistent down 5.5%, Hexaware another 5% gone, Birla Soft, literally no place to hide today in IT. Get into a break. On the other side, we'll invite the management of Naukri.com to discuss the hiring trends seen in the month of March.